Hello and welcome to another ACY Securities podcast. My name is Alistair Schultz and I'm going to be your host for today's trading journey. Today I'm lucky enough to have Darryl Nagel from Method and Madness with me to talk about some of the fundamentals that he finds and has observed of the market over the years and what he finds as an educator that is needed towards learning how to trade. So Darryl, thank you very much for being with us today and I welcome you to the program.
Thank you.
Now, with what's gone on, I mean, you've seen what's gone on over the last couple of years and of course throughout your entire trading career. Would you be happy to give us a bit of an explanation about what it is that your company does and what your role in that organisation is?
Certainly, and thank you very much for the invitation, Alistair. Much appreciated. Yeah, the name of the organisation is Method and Madness, and the reason I chose those words is that for me, to be a successful trader, you really do need a method. And so what I do find in the market, in teaching people how to trade, is that many people don't have a method. And for me, that is literally madness. And so, but sometimes it can be fun. I mean, I've been there. I've been a trader since 1986, so I know all of the challenges that traders have, and you still do have them, except that I developed some tools to be able to help traders to be able to make trading as a business. And I think particularly today, many people really do want to make trading as their business. And the other is to trade with complete confidence, because we all know as traders that emotions are very powerful things. And so with my education program, they're the two goals: to be able to assist traders, whether they're beginners or experienced, to be able to make trading their business, because that's what they really want, but also to deal with those challenges so that you can take every single trade with complete confidence. So what I've developed is, first of all, I developed a program that was just purely designed for a private group of traders that belong to a trading association. And so many of the people that I trained said, look, I think it'd be great if we could bring this to the public. So I've got a team of 3 other traders who are helping me to bring this program to the public. And so what we've done is we've got a workshop, which is about a 2-day workshop if it's face-to-face, or over the internet. It consists of about 8 modules. It's about 12 hours in total. And the reason we're doing a workshop is, to me, the essence of trading is it's experiential and not intellectual. What I mean by that is really about practice.
Yes.
It's interesting, isn't it? That
no, it is.
We talk about doctors, for example, they are medical practitioners. Lawyers are legal practitioners. So I'd like to think of us now as trader practitioners, basically. So a workshop is more designed to enable the actual trader to give feedback, not just listen to a bunch of words, but I think it's in the, really, I suppose, articulating what it is, the challenges that they have, the successes they have. Then what we do is, because it is a journey of practice, we have a community. In that community, we encourage people to be able to practice. And then I do some mentoring, just for those people who like a one-on-one mentoring program. I just take about 10 people, no more than that, so that if people just really want some one-on-one mentoring, and I'm more than happy to do that.
Okay, it sounds like it's a very accomplished sort of and scaled out sort of style of business model, and particularly helping a lot of people learn to sort of get that practical knowledge that's really required that comes into the trading elements. I mean, I know certainly that with some of the qualifications I've done over the years, and certainly seen a lot of traders come through the doors, that you do get a lot of guys that may have only gotten the theoretical side of that from a university degree, but not quite the remaining side of it that they really need. Now, if we can move on a little bit from there, I want to know a bit more before you started Method and Madness.
Yes.
How did you start investing?
Right, well, I go back to 1986. It was during the mining boom, and I had no background at all in trading or investing. And so I'd choose a few of the mining stocks that I heard about back in those days. But that was at the same time that I had an interest in trading itself. And I came across exchange-traded options. And they fascinated me because, from an intellectual point of view, in that not only is it a matter of just buying and or selling, But with options, you've got all of these wonderful strategies with interesting names: straddles, strangles, yeah, iron condors, butterflies, broken wombats. No, I made that one up. But it fascinated me. And what it is one thing is the theory, and it was the intellectual interest in it, but the other side is the practice. And so the practical application of options is a little bit different than the theory. Yeah. So that's where it all started, and I became hooked on it really with trading, and we'll talk a little bit more later on about the journey perhaps.
So what was your very first trade that you sort of ever conducted? You said it was on a mining stock. Do you remember what that stock was?
I think, look, to be honest, I think it was Western Mining. I think that was the name of the company at the time.
And how did it go? Was it a case of, the reason you sort of got really invested into all of this side of the world was because it went really well, I'd have to take a punt at?
It was really, I just heard something on the news about it, and so I bought some shares. But at the time, I didn't really know anything, and so I sold them, and probably if I made any money, it was only just a small amount.
Yeah.
That's how it started.
And so that all sort of started with that options trading side of things. How do you trade now? Are you still using options? Have you looked at other markets? What's it sort of look like for you in today's picture?
Well, I'm still addicted to options. I still love them. And so, yes, I still trade options, but I trade very differently to when I first started. And I have to be honest, when I first started, Alistair, I was gambling. I really didn't know what I didn't know. Now, I probably know a little bit more, but now I'm more of a seller of options, and I use them as a hedge. I certainly like one style of options, and that is what's called the Iron Condor. And the reason for that is that there are periods of time in the market where it just consolidates. The market is going sideways. And so typically, if you're a buyer or a seller, you're looking at trend following, what do you do when the market consolidates, And a lot of times people are whipsawed during that period. So I actually use the Iron Condor as a methodology of making money when the market is going sideways. But also I do still trade. My background is as a corporate lawyer with the Commonwealth Bank, so I still trade Commonwealth Bank, but with CFDs because of the leverage.
Yep.
And I still trade futures on the share price index. So those three, the options, the CFDs, and the futures give me leverage, which is really important from a trader's point of view, while still retaining risk.
And so have you used all of these sort of methods in today's all the way through, or has it just been something you sort of a slow progression to sort of learning each of the different ways that you can trade, the contract types, and do you apply the same methods that you use at Method and Madness to all of them, or is that more specific to just options trading where you started?
Really good question, because what we do at Method and Madness is across the whole spectrum of all of the instruments.
Okay.
Yeah, because, and that is important, so it's not to one specific instrument. I guess for me, I started off with futures because I was asked to do an education program for a company that was teaching how to trade futures. And then at that time I was involved with the psychology part of their education program, and I said, look, I think we should be looking at CFDs. They only had just come into Australia, this is in the early 90s, and so because I found some people found it difficult to trade futures. There's a little bit of issues that you've got to understand about futures. But CFDs is more like just trading shares.
Yeah.
And so that's how I got into CFD. So, and because I'd already trade options from the 80s, I've continued all of those right the way through.
Have you found in the most recent times, when it comes to trading, what are your current views on the world as you see it right now?
Gee, that's a good question, isn't it? Look what's happening in the market today. I think one of the interesting things is that when you look at any of the markets today, and you look at the ranges, and by range I just simply mean the distance between the high and the low of any period, we're talking about daily, weekly, whatever, they are wide. They are really wide compared with prior to March of this year. And so what that means to me, there's a lot of volatility, and you can make money, good money in volatile times, but for a lot of inexperienced traders, it's really a challenge for them. That's where risk is so important today. And the market is really being moved a lot by sentiment, by the latest tweet. So these days are probably one of the most challenging, I think, for traders and investors. But risk, which we can talk about later, is just critical during these times.
So with the current sort of ranges of volatility that we are seeing now in the market, has it altered the way that you are trading, and has it altered some of the instruments that you would usually trade to be not as useful anymore?
Look, that's a really good question, because with my options play with the Iron Condor, where you make the money where the market is consolidating, and we don't see that as much in all of, many of the markets, but certainly with CFDs and certainly with futures contracts, it hasn't changed at all. The only thing that I think is so critical now is the risk strategy. You've really got to have this risk really nailed down. Otherwise, people can just get wiped away with this volatility.
I mean, that's standard in any case and point, regardless of what market you're in at the current time. So, considering these sort of things, and obviously you've been trading in the markets for a very long period of time, are there any elements of what you've learnt over your lifetime that perhaps if you had a time machine at your availability, you could go back and tell your past self, this is what you should be focusing on, or this is where you should be putting more effort into, or something along those sort of lines? Is there one standout thing to you that would say, right off the top of your head, that would say, I wish I had a new one that when I was younger?
Treat trading as a business.
Want to elaborate a little bit on that?
Yes, because I guess when I first started, it was sort of basically gambling, and dare I say, if people are not treating trading as a business, they really are gambling. I mean, gambling can be fun, but it isn't fun if you're losing money that you really can't afford. So to treat trading as a business, it's like any other business, really. So people who've got a business background understand what I'm saying. You've got to have a business plan.
Understood.
And so in trading, it's essential to have a trading plan, but not only a trading plan, a written trading plan.
Okay.
Because I find that, in groups of people, I say, hands up those who've got a written trading plan. You might have 2 or 3 out of 40 or 50 people. A lot of people do have a trading plan, but it's up here.
Yeah.
It has to be in writing.
Yep.
And that trading plan enables you really to approach trading as a business. And there are 2 businesses that I regard as my mentors, really. And they treat trading as a business, and they understand what it is to be successful in the way our markets work.
Yep.
And the first one is a casino. And you might think, but isn't that gambling? But it isn't for the casinos themselves.
It's not. It's the house always wins, right?
The house wins. Now, how do they win? Because, for example, with roulette, they don't know which number's going to come up. And so for me, picking that with trading, I try to say to myself, Darryl, give up trying to work out what the market is going to do today. Now, you can't help yourself sometimes. You think, well, I think the market's going to go up or go down or whatever. But that's a danger to me, because if I start thinking that way, I know that I'm not thinking in what's called terms of probabilities.
Yep.
So the casinos understand that they don't have to know the result of any one spin. I don't have to understand or know the result of any one trade. It's irrelevant. But because we're human, we don't want to have a losing trade. And so going back, I did everything I could to not have a losing trade.
Right.
That is really dangerous in a way. And also, you can't help emotions coming up. Now, I take a completely different view than a lot of educators in this business, and that is to be able to manage your emotions. And I say, no, my emotions are my friend. Because if I was going to have a trade this morning, as an example, and I was a bit hesitant, I was a bit, I wonder if I should take that. straight away I know I'm not thinking in terms of probabilities.
Yep.
I'm thinking in terms of certainties. And we demand certainties in our life. I think we've all experienced certainties in our life, and so why the successful traders are successful is they understand that they don't have to know the result of their very next trade, like the casino doesn't have to know. Insurance companies are another great example, because they don't know who's going to make a claim on their insurance policy, but they don't have to know, because they understand it's very simple mathematics, but it's the mathematics around probabilities that's what successful traders use, and that's what we teach. It's probabilities. Now, it's really it's not the normal way of thinking. Our normal way of thinking is to be certain. I mean, if I take a trade today, obviously I don't want that to be a losing trade.
No, of course.
I mean, I'd be psychotic. But anyway.
So if you were to be going back in time, then, from what I can sort of gather, is that you'd be sort of saying to yourself, listen to your emotions, don't try and ignore them.
Correct.
Focus on the probability elements that are going to help you as much as possible. Now, in some parts, to me, that idea of sort of looking at the probability side, when you deal with the mathematics, it does take a bit of the emotion out of the question, doesn't it?
Completely.
So it's almost like they're two counter things, but they seem to work quite well together for you.
Absolutely, you've nailed it. You've nailed it, because there's a whole industry around the psychology of trading.
There is.
And look, it can benefit a lot of people. So I just offer just another way that may help people, and that is that not to try and manage my emotions, because I believe if you try to manage your emotions, what do you get? More emotions.
So it's about really listening to the emotions.
But it's our friend, because it's saying to me something. It's just like the market is always saying something to me. I don't hear voices, but I've got to always remember to listen to the markets and listen to my emotions. But it's to say, Darryl, you're thinking in terms of certainty. You want this next trade to be a winner. You don't have to, because if you've got an edge, casinos have an edge, insurance companies got an edge. How do they know that? It's because they understand probabilities.
So when it has come to sort of trading, and just for some of maybe the newer traders that are coming to it and are just sort of starting out, they might not have a great deal of capital, and anyone who might be listening to us today, if you were to be dealing with, say, three separate amounts of money, $10,000, $100,000, and let's say $1 million,
right,
and you were thinking about, you had all of these independent times in your life, and it was sort of today, but separate, call it separate universes.
Yes.
Where would you sort of think about investing, and how would you invest each of those independently?
So with the 10,000, I think an ideal way of investing that today or trading it today would be in Forex.
Yep.
And the reason for that is very simple, in that you can take a very small position in Forex. You can have a micro lot.
Yep.
Yeah, so you've got standard, etc. And so to me, if you've only got $10,000, what is so important is that you have what's called position sizing, which is part of what we teach. And so you can have a very small position in the market in Forex and get the experience of what it's like to trade Forex. The other thing I like about Forex is it's very liquid. It's one of the most liquid instruments to trade. And also it's trading 24/5, whatever. So you don't have that gapping. So your $10,000 is I would do only Forex.
Yep.
That's all I would do, and just doing the micro lots.
Okay.
So with the 100,000.
Yeah, with 100,000.
Oh, yeah, 100,000. Okay. Well, what I could do there is trade perhaps the standard lots. I'd probably be looking at still trading Forex, but also I'd be looking at CFDs, because I'd be able to trade those.
So when you're talking about CFDs, you're talking on the commodity side of things, or would you be looking more on the single purchase stocks?
Both, really.
Both?
No, because I think there's something really magic about the commodities. They work in a very different way, because let's face it, with commodities you actually consume them.
Yeah.
Whereas the stock market is a different animal altogether.
Yeah.
No, both. I'd be looking at both, Alistair. And with the million, it's a little bit like the 100,000. When you're dealing with a leveraged product like CFDs and futures, for example, you've got margin. You have to put up margin, because the broker is actually primarily liable for your position.
Yep.
We're secondarily liable, so I have to protect the broker. So I've got to put up an amount of money to protect the broker, which is margin. So that does restrict then the number of trades that I could take. So with $1 million, I'd probably be able to take more available trades on that day than I could with, say, the 10,000 or the 100,000.
Would you consider diversifying between the instrument types? So not only just being in CFDs, would you then look at options as well, or look at other varying natures of futures or whatever it might be that you've used in the past, or would you stick mainly to the CFD elements?
I'd try all three, mainly because I've had experience in them.
Yeah.
And they work in different ways. So, for example, with my options, it's more when the market is consolidating rather than it's trending. So that I still would include that in there. Certainly with the CFDs, either on stocks or commodities, you're right with the commodities. The reason with futures is that they work in a different way again. So I would diversify. And so I probably would do a futures contract on the share price index, the Aussie 200, perhaps rather than the CFD, because I think it's more effective money-wise. You don't have to put up as much money.
So it almost seems like you know, from the smaller amount, as the capital grows, you would start off trying to build the experience to try and become successful with it, then expand the horizon by looking at other instrument classes within the same contract type. And then by the time you sort of get to the big bucks, you're looking at more than one contract type, more than one instrument, and trying to diversify it out. Okay, that sounds like a pretty sane way to do things. There's definitely method to the madness. So, I mean, from there, I mean, we really, for some of the other guys as well, I mean, they've heard now about how you work with method and madness, and what some of your goals have been over the years, and what you might consider doing with some investing money. Are there any particular TV shows you're watching right now, or books you're reading that might link to this? Or if not, what do you like on Netflix at the moment?
Right. Well, I'll go to the book, because there was a great book that came out. It was called The Man Who Solved the Market, by the author is Greg Zuckerman. And it was talking about Jim Simons. I have to be honest, I've never heard of Jim Simons because I haven't been involved with the hedge fund business. The interesting thing about Jim Simons is this. They say he's worth $21.6 billion, that's $billion. That's a good start, right? And with his hedge fund from 1988 to 2018, on average, his hedge fund returned 66%. Now that's pretty damn good.
That's some big numbers.
It's big numbers. And
if you compare it to like the GFC, where some of the best hedge funds, they were like, yeah, we did well. We only lost this much money.
I know. So I thought, I think I want to learn more about this man. I think I might be able to learn something from him. And really, what he says about his success is very simple, and it's what we actually teach. That's why I just love reading the book. It helped to validate, I feel, what I'm doing. And that is, he says it's all about mathematics. And so that's what I really wanted when I first started to put together Method and Madness. I wanted something that was rigorous, it was academic, it's something I could teach at a university. And if it's based on mathematics, we can prove it or disprove it. Now, I'm not a mathematician. When I went to school here in New South Wales, I did general maths, only got a B pass. I'm not a mathematician. So if I can understand the mathematics, anyone can. And all it is multiply or divide or plus or minus. So what I've done is I've broken down the concepts of the theories of probability into something that's very simple. And you talked earlier about getting experience. Of course, that's really the important thing. It's one thing to learn about probabilities, but to actually practice it. And so what it shows with this book is it didn't come just like that. He was a great mathematician, but there was a journey for him to be able to get to where he got with his hedge fund. And so I think it's a really good lesson for people to know that, again, if you treat it as a business. See, when I first started, I was a lawyer. And so, okay, you go to university, you get a degree, But then I had 3 years of articles, which is an apprenticeship. At the end of that, you still know nothing.
Yeah.
And you don't do an apprenticeship for the great money, it's for the experience. And so again, it's going back to what you were saying about the experience. There is nothing like the experience. You can't buy it, and really you can only give it to yourself.
And even from a mentoring capacity or teaching, you can't teach the feeling that you might get when you're doing things either.
Absolutely.
Well, moving on from sort of that bit, I want to know a little bit about the best trade you've ever had.
Right, let's have a look. We might just have a look at a chart here.
Yep.
So this is a chart of BHP back in 1986.
Okay, so before my time.
for everybody in this room's time. Anyway, what happened was I thought I'm going to start trading call options.
Yep.
So with a call option, I'm looking at making money with the market going up. So instead of buying BHP shares, I bought call options.
Okay.
And it just happened just before, 2 weeks before that gap. So you can see that gap in the market.
Yes.
Just this gap up here.
Yes.
What happened there? Now, I could not predict, and I still can't predict what the market's going to do, but what happened was the late Robert Holmes Court made a takeover offer of BHP.
Yep.
John Elliott came in as a white knight. The price just jumped up. I made $35,000 in 2 weeks, and I thought, how great is this? Now, I did come out before it jumped up again, by the way, but I was just through 2 weeks. I thought, hey, this is easy.
So this is what brought you into trading and got you into it to begin with?
Absolutely. And what happened after that is that all through 1987, what was the market do?
Constantly rides up.
Constantly, hey, buy more call options. This is easy, Alistair. Simple way of making money.
So there's a lot of similarities to what we're really seeing in 2020 now. But we might come back to what you think about 2020.
Okay.
I really want to know what you think your worst trade was now.
I'm coming to that now. So during this period, I wasn't only just trading call options on BHP, it was the whole market.
Yeah.
These are just the Australian shares, by the way. So here we can see that run up, and we're now looking at the 19th of October. Now, I was still in my call options. Today, I'd say, Darryl, look at me, look at me, look at me. What is this market doing? The market was screaming, Darryl, the market is no longer going up. And so it brings home to me very clearly that I wasn't listening to the market then. I really need to look at the market now.
Yeah.
I still stayed in that trade on Monday. That was the weekend in New York, and the market had started the next day. And let's see what happened the next day.
Ouch.
Now, on that one day, I lost in excess of $100,000. This is 1987.
How did you convince yourself to get back into trading again after that?
Well, therapy.
Lots of it.
And a few Panadols. Therapy doesn't work now. It just annoyed me. I mean, at first I thought, first of all, disbelief. This couldn't have happened to me. This is, a bad dream. Anger. I thought I'd let my family
Almost
down.
go through the whole grief cycle.
The whole grief cycle. And it brought home to me. So
how long did it sort of take you to get back on the bandwagon?
I guess what I did was I thought to myself, am I going to give this up? That was one choice. Just, Darryl, you don't know what you don't know, which was the truth.
Yeah.
But I guess I was still interested in the intellectual side of trading.
Yep.
And I guess what happened was that I started to go on a journey like a lot of traders do. So I was looking for what I call the Holy Grail. I thought there must be an indicator out there that's going to give me the money. It's out there, I know. I've just got to find it. Or the guru. And Robert Prechter, who at the time was an Elliott Wave technician, he was my guru. And it worked, what he was saying, until it didn't. Then I looked at Gann's work, and when I was asked back in 2003 to be an educator for a company, I was teaching GAN analysis, and the best way to learn something is to teach it. And so by being an educator, that really got me back into
solidified.
Yeah, absolutely.
So you seem to have a break there for a while after this all happened.
Yeah, I did.
And did you find that you were wanting to go back and review what was happening after the fact, and see what changed or what maybe was wrong in the method at the time?
Oh, totally. Because I thought, well, if that could happen again. That may not be a one-off thing. I mean, I wasn't around in the 1930s when the market took a dive, but I thought to myself, Darryl, you were really gambling. You didn't know anything about the market, so I just knew that I had to be educated myself.
Yeah.
And so I was looking at what the market was really telling me going into that period before it went down. Was there something there that I could learn from? And I did. I was able to look at that chart later on, and particularly with what I was teaching with GAN analysis, and it's only very simple. It's just really looking at the angle of the chart. And so subsequently I applied that to the trading going forward.
Yeah. Okay. So it has changed. You know, this event. You know, you had this really good run up coming into it. Then you've had this unfortunate thing occurring where it's had a big drop down in the 87 crash.
Yes.
And it has changed the way that you sort of look at it in the future. You had a bit of a break that sort of went on afterwards to try and regather your own thoughts.
Sure.
What led you to get back in other than sort of teaching GAN theory and learning about other markets? Were you looking at was there a particular thing that said, I want to be trading again? Or was it a moment like that? Or was it just something that you just sort of fell naturally into?
Well, I guess it was a bit of both, and also it was moving into my investments because when I left the bank, I retired. I had self-managed super fund. I had a super fund with the bank.
Yeah.
And then I took the money out. Excuse me. And this is in 2000, just going into 2007, and I thought to myself, I'm in cash, because I took the money out and I've got it in a self-managed super fund. What am I now going to do? Can I learn from this?
Yeah.
And so I did. And I don't know if you want me to show you now what happened in 2007.
Yeah, I would love to see what happened. So this is the GFC, yeah?
Yes, this is the GFC. Now, so I'm in cash. My son, who's a private client advisor, was saying, Dad, you've got to get into the market. You've got to get into these shares. And I said, no, Andrew. And he said, well, why not? You know, why do you think the market's going to turn?
Because there's very big similarities between what we're seeing on this chart now compared to what we saw in 87.
Exactly. And so 1987 was a gift, because if I didn't have that experience, I wouldn't have known what I knew then in 2007. So he said to me, Dad, why do you think the market's going to turn over? I said, I don't know. He said, well, when is it going to turn?
It's just like instinct, isn't it?
When is it going to? I said, I don't know. But the market always talks to me. So I kind of get the concept, because I quite often feel a little bit the same. I wouldn't say it talks to me or I hear it, but I certainly do get a gut feeling or an instinct of some kind that says, I don't know if I like the value of this. That's right, and that's from your experience. You see.
Look, if you had have asked me to do that back in 2007. No. You know, I think I got pretty lucky back in 2007 when I was on the trading floors. Regardless, but
at some level, as you said, instinct,
some
gut
deep-seated
level,
little warning bell goes, hey, pay attention.
But basically, it's just the angle of those last few bars. This is a weekly chart, but the angle was acute. So the market, you can see the angle as it's going up is getting more and more acute. Now, steeper. Now, 2007 was interesting because you can see where the market went up and then there was that big downweek.
I mean, if we were to look at the NAS 100 now, the angle of it now, it looks like it's taking off into the stratosphere.
It's like a cliff?
It's going...
Now, when you see the cliff, all I can say is...
Hold on.
Don't jump. Yeah. But the issue is this, that 2007 wasn't the same as 1987.
Completely different economic impacts.
And so that's where the trap for a lot of younger and older players like me can be, is that we think the market's going to repeat exactly. It doesn't.
No.
So, but I just said to myself, no, I just want to keep out of this market, and that saved me quite a lot of dollars. That brings us to this year. Now, it doesn't look the same at all.
No.
Nowhere near it. And that's why the market wasn't talking to me the way it was in 1987. However, what was saying to me prior to February, and this is a good time prior, was what was happening in the real world.
There was a lot happening in the real world. I mean, I think even prior to this, the pandemic-induced fall that I've seen personally was, last year we saw 10-year Treasury yields invert, which prior to every single financial crisis for the last 60 years of recorded history on Treasury yields, if you saw the 10-year Treasury invert on US dollar, then you were likely to expect that within a 6 to 24-month time frame, we would likely see some level of a recession to loom. And it's in every single one. And it's always been between 6 and 24 months.
You never know.
And this was no different. I think, 3 months before we were starting to, or even 6 months before, we were starting to see, this 10-year Treasury thing. But then about 2 months before, we saw 30-year Treasury yields invert, which have never happened.
Ever.
And that was a very big factor for me to sort of go, hang on, that happened in GFC, that happened in 87. It happened well before that again, and now it's like, there are certain patterns that do repeat themselves, all but in their own sort of personality as it develops.
That's exactly right, Alistair.
So what else did you see then? I mean, I saw this sort of inverted yield curve stuff. I personally felt that there was a lot riding on what is going on in the market right now. You're seeing, high, not extreme levels of volatility or anything like that. It was pretty stagnant almost for a while.
Oh yes, there wasn't volatility there.
And then you also but you were seeing sort of prices of, or the value of certain items going up. And we had the rise of companies like Uber and things that don't actually make money on that level, but then you get ridiculously overvalued sort of pricings.
You do. And so I guess a lot of it was because in my age bracket too, I just thought, what's the most important thing for me? And it's preservation of capital. Some of my friends say, well, how much money do you make out of preservation of capital? I said, precious little, but what's important for me, if I was in my 30s, I would take a different approach. But for me, and this is what's important for each trader, to know what is right for them. And this is what we actually don't give, just to divert a bit, we don't give a trading plan to people. What we do, we do show each of our 4 ways of trading, but we are very much about allowing and assisting traders to find their own trading plan, because to me it's unique. So for me, it was unique for me to go more into cash than in shares. I'm still in shares, but I'm substantially in cash. And I'm looking at going back into the market at a stage where I feel more comfortable
with it.
In going into it, definitely.
I mean, I suppose one of the other elements we could look at when it comes to the this pandemic-induced sort of thing is really the rise of tech over the last 10 years. Even leading up to the GFC, we were seeing a lot of new tech firms come out and about. E-commerce has obviously boomed with companies like Amazon. And then now, whilst the pandemic's been operating, we've seen these very big figures. We've seen things that have been going on a little bit wild across the world. But at least to me, I mean, I still think when I look at the tech industry and I look at some of the other things, especially on the NAS or the S&P, you do see some, those charts there that you see in 87, the GFC, and now 2020, looking pretty obvious to me that there is something not quite right. And it certainly speaks volumes when I sort of think about that little intuition bell or the gut instinct or perhaps the market talking. Now, having a little bit more of a move on to more, the idea of, you've obviously taught a lot of different people and mentored people over the years. What is it that you find contributes towards developing a successful trade or a trader or even a trading plan? What sort of fits into that narrative for you?
Yeah, well, exactly that. You do need a trading plan. So what are the elements in that? And so obviously with a written trading plan, you work out what instrument are you going to trade? What time frame? See, for a lot of people, they may not have the time to sit in front of a screen. I don't.
Yeah.
And so a lot of what I do is based around my lifestyle.
Yeah.
So you need a trading plan. You need risk management. That is critical. To me, the focus is on risk, not reward. I know it seems a bit unusual, but to me, the name of the game is to stay in the game.
Yeah.
And so, but risk, what's interesting, Alistair, is risk is the one thing that we can absolutely control and have certainty about when we're going into a trade.
Yeah.
It's the only thing, to be honest.
Yeah.
And of course, who gives us the money? I'm in a trade now, we'll say. Who gives me the money? Not me. It's those other people in the markets who actually give me the money. The people who are in the market today aren't the same ones that were in yesterday.
No, they're not.
So we don't have any control once we get into the market. So what is important is to have that risk in place. And really, one of the things that I find traders find hard to accept are losses.
Yes.
A losing trade.
And it affects the psyche
Totally.
so much in some instances.
Huge. And look, I'm the same. Obviously, back in '87.
I think unless you were able to really cut it off, you basically want to see a psychiatrist if you were able to, because you're looking to go,
well, you're not
are you
human.
psychopathic? No, that's right.
Well, you're not human. So I'm human. Do I still have emotions coming up? Of course. But I've got the tools. So I know with risk management, I know where my entry is, where my stop loss is. That's the risk on the trade. So I know what's the account risk, what percentage of my account am I going to risk. I've got the trade risk, the difference between my entry and my stop. And then that gives me the position sizing. And so we've got a very simple algorithm.
So it's almost like you sort of take, earlier you were sort of saying about the idea of the treating it like a bit of a business.
Yes.
So it's almost the same sort of thing. If you're going into business, you know what risk you have there, and people sort of put that same concept of, if you're going into a business, then this is what my failure rates might be, or this is what my success rate might be. You have a business plan in place.
Exactly.
But then when it comes to the trading side, I mean, I know it's a common element for me, and I'm sure it's very similar to you, is that people who are new to it or treat it a little bit as a hobby, or they're not treating it just like as a business. So therefore, if you're not treating it like that business, you're not going to get the business results that you want.
You won't.
So does that fit the same sort of thing for you?
It is. The extra ingredient, the one that's not sort of common, is understanding how the market operates. It's an auction.
Yeah.
And the closest I can get to is looking at the casinos and looking at insurance companies. They understand probabilities. So if you really take a risk, why would you ever be upset if you took a loss on that one trade?
Yeah.
So what we tend to do, we're human, we focus on that next trade, we want it to be a winner, but that is not how the market operates.
No.
And that is a danger for us. It's
It's
the number of trades.
And understanding that auction process behind the scenes is a huge amount. I mean,
well, you've been on the floor, haven't you?
I have. But even then, like my time and experience that was on the trading floor, and in a variety of other places, that run with similar sort of exchange-driven programs, you don't get the same things that you were seeing in 1987, or when we think of movies like Wall Street, Money Never Sleeps and stuff like that, there's not guys on the floor anymore holding tickets up where that open outcry of the pit is blatantly obvious.
It's obvious.
If you were to go back and watch some of those older movies or TV shows, you see that auction process up front. You see people screaming out numbers. But these days, I mean, the closest representation I suppose I can actually see to it today that you can to help sort of formulate and understand, whilst we're seeing everything on a computer from a digital perspective, is to really have, look at housing, look at the auction processes that you do know.
That is it.
If you understand how a housing auction works or property auction works, then it's the exact same process, but you've got way more people involved, and instead of trading, thinking about buying the house, it's about a stock, and you just can't tell who that person is anymore. So, from that side of things, I think that's the easiest way I found to explain it to people.
Excellent. I agree with you. It's the significant number of trades. You see, the problem is, and often you don't see this being written about, and that is, it's what's called, in some cases, the law of large numbers. That's a fancy word of just saying taking a significant number of trades, because you can have an edge. First of all, you've got to have an edge. If you don't have an edge, then you're gambling.
Yeah.
But you still have to have a significant number of trades for that edge to cut in, because the result is absolutely random. It's a bit of a paradox. We're looking for the certainty within the uncertainty. The certainty is what probability theories can help us with. The uncertainty is what the market is doing. So it's all of those elements that make up being successful.
Yeah, no, I absolutely understand. And the probability side seems to be a major component to your own teachings, but also your own trading. And how it all sort of fits together is something that I think is going to interest a lot of people down the track. So thank you very much for sort of talking about those today. What are some of the common misconceptions that you find, though? I know for myself, this idea of people treating their trading like a hobby and not as a business. What do you think are some of the other implications, or maybe some of the other expectations that people that might be new to trading have, and how they think about it in general? Do you think that's the only mistake they make, or do you think there are other ones that come along with it?
Well, I think the expectations are reasonable. Now, the whole industry is taught about, you're taught to, the whole point of it is to make money. Okay, so I'm expecting to go into these trades expecting to make money. Very reasonable. But what I don't think is taught is that how do you really do that on the longer term? So what we're often taught is you just use this indicator or that indicator or a whole series of indicators. And I have to admit, when I first started off, I wouldn't have 2 moving averages, I'd have 6, I'd have Bollinger Bands, I'd have RSI, I'd have MACDs. I had so many indicators on the bar chart I couldn't even see the bars. And so what we tend to do, I think when you just start off, the expectation is I'm going to find this magic indicator. All indicators work until they don't. That's the facetious way of putting it.
I don't really even use indicators. I don't at all anymore.
Well, people don't, but that's how it's taught. And so I understand where the whole industry comes from. They're wanting, in a way, they're not educators, if I can be. They are really more marketers. So the marketing,
to me, on that sort of side of things, where it's the indicator side that people sort of focus on,
yes,
is a little bit of the human desire to naturally go towards being black and white.
Yes.
It's either you're either in a position or you're out of position or you're not.
Yeah.
It's either yes or it's no. But the reality of the situation is you've got 2.5% black, 2.5% white, and then the rest is grey in between.
Absolutely.
So I feel that there is that sort of misalignment of what reality of trading
Correct.
actually is.
Yeah.
And then how people want to look at and view the world, which is fine. But if they're getting taught to do it in a way that does feed into those misalignments of reality, it makes it more difficult for them to sort of go through.
Totally, and I understand. I've been there, and like every other trader.
I think that's the most common thing. Like every successful trader sort of starts somewhere down there and travels their way through it.
And look, I have to be honest. Every now and again, I'll come across something new, like Ichimoku. I came across in 2013. Straight away, I wonder if this is, like you can't help yourself,
especially if you're on that sort of technical front. So those expectations that they sort of generally have, and we've spoken about the idea of them sort of being misaligned to reality a little bit. How to sort of help some of these guys who might feel they're in that position. How do you approach the market on a daily basis? Maybe it might give them a bit of insight into what a professional does that they might be missing.
Well, I first of all, I have to keep it very simple so I can understand it. I don't have anything complex. So how I start the day is all of the analysis has been done. I do no analysis when I'm first taking a trade. None. Zero. if I'm tempted to analyse what it is that I'm going to do, this is Darryl, I'm going to be in strife, because I just follow a mechanical system. It's the maths that do the work for me. So I have a series of trades that I can take, and typically before the market opens, I've already put the trades on.
Right.
So I have bracket orders, so I have a limit order. So I don't make the decision, I'm going to get into this trade now, looking at what the chart is doing.
You've got it set up so that it takes some of that guesswork out.
Totally, because I'm not that intelligent. The market is more intelligent than me. So what
I
I
would say
like...
the market's more emotional than me at the moment.
So it's the market that gets me in, it's the market that gets me out.
Yeah.
So I've given my bracket orders to the broker. That frees me up with my lifestyle, that I don't have to look at the market.
Do you have another part of your routine? Like, is there sort of, when we think about, having this trading plan, are there certain times that, you will tell yourself, I'm not going to trade and outside of this trading plan, or is it all locomotived in one direction with it?
No, there are times where I stop. I mean, I don't think we have to be in the market all the time either.
In my mind, if you're not in the market, you're just neutral in the market.
Well, yeah, I mean, to me, and this is just me, I think it's healthy in my mind to have a bit of a break.
Yep.
Because you're obviously focusing, you're treating it as a business.
Yep.
And so I just don't want to be... focusing on the business, day in, day out.
Yeah.
So there can be a period, and like this is a period now, where I can have a little bit of a breather, mainly because what the market is doing. Now, there are some interesting things, though, that some of the, and we did see it, if I just go back, just having a look at that chart of the XJO, which is the Australian 200, you can see what the market has been doing. This is up till this week. It's going sideways.
Yeah.
So this is nice.
You've got higher highs, lower lows, and then they're getting higher lows, lower highs.
Yeah.
So it's like the perfect definition of almost sideways.
It is a sideways. Now, that is beautiful for me. So I have to be honest, I am going through each of my charts. I haven't put this into a mathematical calculation, but I will. So I am looking each day at the market, particularly in America, and to see which options I'm going to take on American markets. So I am doing that outside of the mechanical.
What about from a psychological perspective when it comes to the looking at the trading plan or in your routinely daily thing? Do you do much on the psychology side of things of trading these days still?
Well, that's a great question. I'm glad you asked it, because I started off, before I did law, I majored in psychology at the University of Sydney, and I continued on my journey of learning more about psychology. I didn't become a psychologist, but I got very heavily involved in it. In fact, my first presentation to my association was back in 1996 on the psychology of trading, and so I used to teach psychology of trading. However, I just felt, whilst I was doing it, there was a part of me that thought, I'm wondering whether we have to really examine human behaviour when we're talking about trading. Now, what else do I do in life where I have to work out whether my mother loved me or not, or whatever, or I have to analyse, Darryl, why do I have to get inside my brain? Why do I have to look at my subconscious? And look, I'm not knocking the psychology of trading. Look, I am not. I don't want to do that. But to me, I didn't think that was the answer for me. I think the beautiful answer is this, that we have a mechanism that is perfect for us to deal with the psychology of trading. So if I am hesitant about taking a trade, I know straight away I don't have to work on myself, I don't have to put on motivation tapes or anything like that. All I know is I'm not thinking in terms of probability. Because if I'm thinking in terms of probability, I have no doubt.
It's interesting what you say about the psychology front, because myself, I'm almost the polar opposite to you when I think about the psychological situation and how it's working. I actually tend to look at the idea of what economics is really the behaviour of how people spend money, or the psychology of how people actually spend money. So to me, and especially in 2020, there's a lot of emotion in the market. So I kind of feel that the psychological elements are playing a little bit more in the field than what they would have done in the past. But nonetheless, the mathematical side or the probability side still remains to be useful, especially if we're looking at it from a money management sort of perspective. But to move on to maybe something else that's a little bit different to look at, we've looked at the idea now of how you run method and madness and what it is when it comes to trading plan and what a trader sort of do. But when it comes to the trading plans themselves, do you look at the idea of forward testing and back testing? Is that what goes into the building, I suppose? Because a trading plan is almost like a strategy, right?
Yeah.
Yeah. So is there use of the forward testing and back testing to a certain degree in that sort of front?
So there are two ways of looking at that. The first is looking at back testing. Now, I say you have to back test. And the reason for the have to back test, and therefore you have to have a written trading plan, etc., is only in that way do you know whether you've got an edge or not. So an edge is just a mathematical calculation that you've got the probabilities on your side. There's more likelihood or not that if I bought BHP today, it's more likely than not it's going to go up or go down, whatever, according to my back testing. So what back testing does is it enables you to mathematically, academically, scientifically see the result of each trade that you would have taken in accordance with your trading plan and see whether or not there's a positive expectancy. Now, it may well be that my trading plan that I'm thinking of tomorrow as a newbie, I'll always backtest because I don't know whether it's going to be a positive expectancy or not. So the advantage of that, the power of that, is that if I know that I've got an edge, I will trade with complete confidence. So not a problem. And that's important. I think that's really what traders want. So having done that, that is just seeing whether or not I would have made money during the period of backtesting. But what about going forward? And so what the forward testing does is to enable me to retain that edge, because we believe the market's never the same. So market's always changing. So what a pattern may have worked over a period of the last 2 or 3 years doesn't mean to say that it's going to work exactly the same going forward. And if I can give you an example of my mentors, like with casinos, before people cotton onto the fact that you could actually count cards in blackjack, they had an edge. But people who learned how to trade the cards, to read the cards I should say, they got a greater edge. So that was where the market changed for the casinos. They had to change the rules because it's quite legal to count cards, but the market changed for them.
It's ill-advised in the casino if you get caught, though.
Well, they don't have a sense of humour, Alistair, so they will walk me out of the casino, or if they think I'm counting the cards, they just close down the table.
Yeah.
So forward testing, I think, is equally important.
Yeah.
But if I don't know I've got a positive expectancy, I'm just hoping.
Yeah.
And that's the psychology of it. Gee, I just hope this trade works tomorrow.
So which one do you find to be more beneficial? I mean, to me, it sort of sounds like on the backtesting side of things, you need to have that in order to know whether it could be useful, and then the forward testing is really proving the hypothesis.
Yes.
And so out of the two, if there was someone only going to choose one, which would you choose?
Oh, the backtesting.
The backtesting. So it's always got to be backtesting first, forward testing secondary.
Correct.
Okay. And if someone was to start learning to trade now, do you think do you have anything that you think you would recommend to them, or that they should seriously consider looking at if they are interested in trading?
Yeah, well, a lot of us read books and look at webinars and whatever, but I'd be seeking an educator who isn't a marketer, who actually trades. I think that's important to have an educator who trades.
So it's important to make the difference between, say, a education someone who's going to mentor you versus someone who is just going to give you a one-size-fits-all approach.
That's right. The one-size-fits-all, I think, just doesn't work at all because we're all different. So, but from a marketing point of view, I understand why they do that. But yeah, there are many people out there who are not only educators, but they actually trade the markets. That's important because it's that practical aspect. There can be the theory, but when you put the theory into practice, like to me, it makes sense to have somebody that you know are actually trading as well, and who are coming from a purely educational point of view rather than trying to market a particular indicator.
Yeah. And what do you think are the most significant opportunities for someone to enter the market today? If they had never traded before, what do you think would be the most useful thing for them to learn or to know about 2020 as a year for trading?
Well, in a way, a lot of people are finding it easier to enter the market because they're at home, so they're not at work. But if they are working from home, they've got more opportunity to trade. I think these days there's a lot of opportunities to trade various markets. I think more and more like ACY.
The accessibility.
It's the accessibility to be able to trade everything that you want to trade, which you can through ACY. I think that's important.
But does that operate a bit like a double-edged sword though? Like you've got, you're broke for choice. So which one do you start with?
That's where it's important. Your mentor, your educator, because they should go through a process of getting to know you, and to say, well, Darryl, given your interest, given your ability to be able to trade the market, given your account size, this is what I recommend you look at. As which instrument are you going to trade Forex? What time frame? Daily, weekly, or is it going to be intraday?
Yep.
So that all comes into it, and then I think these are really good days. The only thing about today, at this very moment, is the volatility in the market. So you really need, I guess, how I look upon it is, it's like starting off in any occupation. You start off as an apprentice. So this is a great time to become an apprentice. If I was just starting off, I'm not trading with the intention of making money, but the intention of gaining the skill. So whilst it's a bit of a wild ride, but also I think it shows that if there was another downturn in the market, to show to people you can make money on the downside as well as the upside. A lot of people have a bias. I'm only going to buy the market and not sell it.
Yep.
It goes up by the stairs and down by the elevator, as we saw in those charts. So perhaps this is an opportunity for people to see that they can actually make money with the market going down. Hopefully, there's a petition going around that doesn't work, and that is, the petition is to stop short selling.
Yeah.
And that's how we make money out of it. And I think that's important, to be able to short sell as well as trade on the long side.
I mean, if you didn't do that, there would be no equilibrium to the economics of the market.
No.
So then what's the point in actually trading it, right?
Yes.
Now, before we sort of wrap things up today, Darryl, there is always one question I ask every guest that we have on the show. And this is, what are the most significant opportunities, challenges that you think your industry is facing over the next 1 to 3 years? Which I suppose is my industry as well. And for many of the people listening who are trading or in it, their industry or potentially their business futures.
Well, one of the challenges is the one I was mentioning about short selling. I think if that comes in, that would be a disaster. But I'm fairly optimistic, because I think there is just more and more ways in which we can learn about the markets. There's more and more analysis. Like, for instance, Ichimoku, I only heard about that in 2013. I'm sure there are other indicators that are coming out all the time. So I think this is a great time where there's an explosion of technology, the ability to be able to trade the markets for the average mum and dad is much greater today than ever.
So it's a bit of a case of having, more opportunities available to us. The accessibility is easier.
Yes.
And that it leaves us with potentially a very big area of growth when it comes to the ability to actually be performing and also accessing the financial markets across the globe.
I think it's one of the most challenging things to trade, but it's also the most fulfilling.
And exciting, depending on when you're trading.
Exactly.
You might be holding onto the seat of your pants. Well, thank you very much for being with us today, Darryl. And I look forward to catching up with you in the near future about getting another one of these so we can see what your thoughts are in perhaps several months' time and find out where you're sitting now, what you're thinking about the markets then, and what it all looks like in review of today. Well, that's all we have for today at ACY Securities. I hope you have enjoyed this, and please feel free to send in your comments to Darryl and or myself. We'll be able to put up a little bit of a blurb for him to show where you can either email either of us and or get in contact and check out some of our websites. Hopefully you've enjoyed it, and we'll see you next time.